This is alarming. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the banks just did the unthinkable, and what I want you to understand is why this means a hard landing is coming. Now, the prevailing view is that that's not even a possibility, that we're more likely to experience just a minor slowdown, or at worst, a soft landing. And this is what we just heard from the Fed. We're hearing from politicians, and now even people inside the manufacturing sector, as we'll see later in today's show, are starting to become optimistic. But when you look at what data we just got yesterday and you see what it means for the economy, it doesn't suggest a soft landing is in our future. It says by the end of the year, we're more likely to be in a hard landing. Plus, we have a sponsor for today's show. We have a Canadian diversified mineral exploration company that just had a major announcement, and we think based on that and their chart setup could be the catalyst to see their stock double or more. Stay tuned to the end of the show or check out the description or pinned comment for more information. Now, if you're wondering what we're doing inside the Federal Home Loan Bank, which you may recall has lent a lot of these small and mid-sized banks a ton of money, well, it's because when you look at the report we just got, it's going to say the banks are going to need a whole lot more money based on what they just did. Let's sort of Bloomberg, where we picked today's story up with a headline. The Fed says U.S. banks tighten credit further in the wake of failures. Now, I disagree with their assumption in the wake of failures, but what we do know is that banks have tightened credit conditions even more. And what that means in a debt-based economy, it says the probabilities of a recession or now even a financial crisis start to come into play. Because when you understand how our system works, is we perpetually need the creation of new money, not only to spur economic growth, but to pay on the existing debts. And right now, we've got a whole lot of debt, and interest rates on that debt are going even higher, meaning service costs are in a big problem for consumers and businesses, which is why we need the banks to be lending. And as you're about to see, they're going to do the exact opposite. The Federal Reserve said that banks reported tighter standings and continued weak demand. So this is important. Weak demand for loans in the second quarter, extending a trend that began before the recent stresses in the banking center emerged. So here we're seeing is consumers and businesses saying, look, for whatever reason, maybe they don't believe they can get credit, or maybe they just don't want it, or saying, you know, I'm not that interested. And that's a problem, again, because we need new loans to create new money. The proportion of U.S. banks tightening terms on commercial industrial loans for medium and large businesses rose up to 50.8%, up from 46% in the first quarter, according to the Fed survey, the Senior Loan Officer Opinion Survey released on Monday. Now, this is something that we track on a regular basis, and so what it's saying is that more banks are tightening standards. That means it's harder and harder to get a loan now, means less money created, big problems coming for the U.S. economy. And here we can see the net percentage of domestic banks tightening standards for commercial industrial loans of all sizes, and now it's gone even higher. Now only, if you exclude the pandemic, the second tightest, or close to the second tightest on record back during the dot-com bubble. And something I want to point out as we look at this slide is you'll notice there are gray bars associated when banks tighten lending standards. Well, that is a recession. So the one as we think going forward here is the prevailing view is, just minor slowdown, maybe a soft landing at worst. The base case becomes a hard landing by the end of the year, as you'll soon see. The collapse of 4 U.S. regional banks since March sparked turmoil in the financial sector and increased concerns that lenders would rein in access to credit in a way that could tip the U.S. economy into a recession. Recent data, including last week's report of greater than expected growth, that being the GDP report, has shown the economy has been resilient in the face of turmoil. And so the whole notion here, the belief is, because we had a banking crisis, banks would actually tighten credit conditions. Let's put this in a different perspective. Let's say you had a bunch of auto dealers and one of them failed. Does that mean the other dealers would say, hey, you know what, maybe we should sell fewer cars? No, in fact, they're going to look at this as an opportunity to say, hey, look, they failed. We're still in business and we have cars, come buy them. So that's the kind of the view here, is that the banks are curtailing credit out of some fear, when instead this should be an opportunity to gain market share as their competitors standards go down, and that is a false assumption because the real problem is the yield curve. And here you can see the same net percentage of domestic banks tightening lending standards for commercial and industrial loans, firms of all sizes. That's still in blue. Now remember, anytime the blue line is above the horizontal black line, on net banks are tightening. If it's going up, they're tightening more. And if it's going down, that means fewer of them are tightening, but still on net tightening. And we've got the yield curve overlaid here. And this is a 10-year minus 2-year. And what this means is when you see it, the red line, below the horizontal black line, it means that 2-year yields are higher than 10-year. And because banks borrow at the short end of the curve and lend at the long end, it means they don't make money lending. So instead of the notion that this is a banking crisis issue from earlier this year, what we can see is anytime the curve flattens out or goes negative, meaning banks lose money lending, they start tightening lending standards and only want to lend to those who they really want to. And you can see this happen over and over again. And now we're seeing this, of course, the second largest inversion since the 1980s. Of course, we know that lending standards then were very tight. We saw back-to-back recessions, and that's the real catalyst here. Has nothing to do with what happened back in March, but of course has everything to do with the inverted yield curve as the Fed attempts to slow down the economy. Of course, they think that they've got it nailed this time, as many believe, but they don't. The tightening in lending standards generally intensified. Here we can see this from JP Morgan Chase economist Daniel Silver. But look at this. The historically tight data, quote, are not a guarantee. That's true. Nothing is indeed a guarantee of a recession to come. But the tightening evident as of late suggests the economy should slow. But yet, notably, every time this happens, we see a recession because, again, as you pull back the amount of money created in the economy, there's less and less money to drive economic growth. You usually have a whole lot of debt at the end of an economic cycle. That debt needs to get paid. The Fed is usually raising rates, causing the servicing cost of that debt to go up. If you don't have enough money, what happens? The economy starts to slow and then at some point contract. So he says it's not a guarantee. Well, it's pretty close. As credit demand we see in the survey showed low demand for credit persists despite some improvement. The share of banks reporting weaker demand for commercial industrial loans among large and mid-sized firms fell to 51.6 from 55.6 in the first quarter. And why would demand fall? Because business is slowing down. So if you see new orders dropping, if you see backlogs being worked through, as we're going to look at in a little bit, what it means is businesses don't need loans, so they don't ask for them. Again, it's all signs of an economy that's slowing down in a big way. The poll known as the Senior Loan Officer Opinion Survey, or SLOOS, showed banks expecting to further tighten standards. Now, this is a big problem. Not get easier, but further tighten standards on all types of loans, citing a less favorable or more uncertain economic outlook and expected deterioration in collateral values. Now, could you imagine that? The collateral values they see dropping and the credit quality of loans is a reason, not to mention the one thing they didn't say but should have said is the Fed is still intent on raising rates, which means further inversions of the yield curve are likely to come, and that means credit standards have to keep getting tighter as a result because the banks are just not in a position to make much money here, even though rates are up. So at a time when banks want to lend, the Fed's putting them in a position where they can't make money lending. That means credit conditions get tighter through the end of the year, and that spells bad news or a hard landing for the economy. Overall, the data in this survey are, quote, at least consistent with the tightening in credit that the Fed has been aiming to achieve with raising rates, although credit was still tightening from easy levels, so the overall impact on activity is less clear. I would say that the bigger impact had to do with the fact that consumers did have some pandemic money sitting around, and I believe we're pretty much through that, if not very close to the end. Again, looking back at a different survey in June, saying consumers struggle to pay their bills suggests going forward that without access to credit and tightening credit conditions, that the economy should start to see a marked shift lower. And here we can now head over to the manufacturing sector as we look at the S&P Global U.S. Manufacturing PMI. This has come out today to look for evidence that these tighter credit conditions are causing problems. And sure enough, what is the headline? Decline in manufacturing performance softens in July, suggesting that, well, it's going down, but, well, not as much. But let's look at the details in this report, and then we've got another one, and it's shocking. U.S. manufacturers signaled further decline in the health of the sector during July, according to the latest survey from S&P Global. The downturn stemmed from another, get this, monthly contraction in new orders. So again, demand component from tight credit conditions validating what we're saying as domestic and external demands conditions remain muted. A challenging sales environment led firms to scale back their input buying, causing inventory holdings to be depleted strongly. Despite a sharp fall in backlogs of work, this is critical. Once backlogs go away, you're going to see employment start to change. As new orders drop, companies expanded employment at a faster rate. Now, that's not what normally should happen. They should be firing people, but they have a greater confidence in the future. And looking at the number, it came in at 49.0 in July, up from 46.3. Remember, at a level of 50 means unchanged. So just a slight contraction over the month before. But let's look at some of the other details as their chief economist at S&P had to say. Manufacturing continues to act on a drag on the U.S. economy. Producers are clearly shrugging off recession fears. They're getting ready for a second half rebound. I'm going to show you why that's not going to happen at all. The sector continued to suffer from lower demand. How about this? Marked improvement in business expectations for output in the year ahead. So it's telling us these manufacturers are optimistic, and prices charged for goods consequently barely rose for a third straight month, which should help subdue consumer price inflation in the near future. And that is for sure going to likely happen. Of course, we know that inflation is coming down anyways, but now let's shift gear over to the ISM, and then we've got a whole bunch of charts to look at, because what we see coming from the manufacturing sector is leading the economy down. It's validating everything we're seeing in these tighter credit conditions and suggesting, again, not the optimism the equity market has, but really an outcome of a hard landing. And here we can look at the quote-unquote official manufacturing PMI, because there is no government version of this, but the ISM is considered the gold standard over S&P Global. They came in at 46.4, suggesting a slight contraction in the manufacturing sector. But get this, the economic activity in the manufacturing sector is now contracted as of July for the 9th consecutive month. Now, that doesn't bode answers or questions. It does actually ask questions of why everyone's saying, look, we think the economy is booming, but yet why is the manufacturing sector contracting for 9 months? Why are commercial industrial lending demand down? Why are new orders down? Why are we seeing this if the economy is booming? Well, let's take a look at what some of the respondents to the survey had to say, then we'll get into the numbers. Customers are reducing or not placing orders forecast. Sales in our industry extremely low. Another said, how about this? Demand is softening and leading us to longer-term uncertainty. So short-term, they're confident. Longer-term uncertainty. Suppliers are starting to reach out looking for new business, suggesting that they don't have enough business, and they're seeing softening occurring in Chinese markets, as we actually pointed out the other day in our show. So let's get into the numbers here and look at some charts, because again, I want to break this prevailing view that the Fed and politicians and all these other experts, even people at the factory, don't understand that our economy, because it's debt-based, it's all about the expansion of credit. And when you cut that back, as the banks are doing and the Fed's trying to do, well, it doesn't bode to a happy ending. Here you can see the manufacturing survey at a glance, looking at the July data. New orders, 47.3. So we see continued contraction for the 11th straight month in new orders, suggesting demand from U.S. consumers is falling. Now, here's the interesting thing. The S&P Global report noted that the employers were hiring. But here we see now the trend for 2 months is a contraction in employment in the manufacturing sector, which we should see in the non-farm payroll report later this week. And I've suggested this is going to happen. And why? Because as you have a lack of new orders and you've worked through your backlog, look, your backlog's at 42.8. This is a pretty strong contraction for 10 months in a row. There's a point where you say, look, I've got employees and no work for them to do. So what do? do? You lay them off. How about prices? Again, the inflation component slowing down 42.6. Again, strong contraction there. Even export orders, despite the weaker dollar, at 46.2. So suggesting everything we know, the manufacturing sector is slowing down. But does it really have everything to do with credit? Well, it does. Here you can see the net percentage of domestic banks tightening standards for the commercial industrial loans to firms of all sizes. And we're going to put this because, again, we don't have the S&P Global or ISM data in the Fed database available, but we do have the Philly Fed. So we're going to look at the Philly Fed General Activity Index from the manufacturing sector there. And lo and behold, what do you see? When these firms tighten credit, as banks tighten credit, what happens? Manufacturing activity goes down. Tighten credit, activity goes down. You see this happen over and over again. And now the view is there's going to be a resurgence, but on the backs of the fact that banks are tightening credit conditions, not a chance. In fact, it means we're going to see more people lose their jobs. And now we're taking the same chart, but this time we're swapping out general business activity for current work hours, again suggesting, as we note, that as credit conditions tighten, demand goes down, number of hours worked falls here. You see it happening again now. So even though we haven't really seen marked layoffs yet, it means that those who are working aren't getting the hours they want. And look at this next chart. When we took the current employment and overlaid current work hours, so work hours in red, employment in blue, suggesting just with a slight lead that as work hours go down, eventually what follows is layoffs, and that's what we're starting to see here. So it's almost surprising that many of these experts are saying that they don't see any bad things for the economy, when historically it says all of that. And that's also the reason why it means interest rates are likely to come down, because when credit conditions tighten and you don't have enough money in the economy to keep it going, rates need to fall to spur actually a lot of new loan creation. And that's why you see when credit conditions tighten, interest rates make new all-time lows. This is a 10-year treasury yield. You see it after the global financial crisis. You saw it during the pandemic, and many don't believe it can happen now, but it's very likely that we'll see it happen again. And one thing we are bullish on is not only just yields going down, but it's our sponsor for today's show, and that is Q Battery Metals. You'll take a look at them. You can find them on the OTC under BTKRF and on the CSE under QMET. And this company, we think, I'm going to show you why we believe that their stock price could double. We're going to put all of their information on their website, analyst report, everything in the description and the pinned comment below. And Q Battery Metals is a diversified Canadian mineral exploration company with operations primarily based in the world-class Abitibi Greenstone Belt region of Val d'Or, Quebec, as Q Battery Metals currently holds 100% ownership in 6 separate critical element projects in Canada, which we'll briefly look at each of them here in a moment. And they're exploring potentially right now for lithium, copper, nickel, cobalt, zinc, molybdenum, and PGE, all listed as critical metals by the Government of Canada. Now let's take a look at their stock, because one thing I want you to look at as we zoom way out as far as we can, you'll notice the volume profile lines at 19 cents a share, and at time of recording it was trading at 3 cents a share, making this one of the easiest and least expensive sponsored stocks that we've had that you can get involved in and see a potential large upside potential. Because what it means at 19 cents a share is this is where a lot of investors are sitting at and holding, looking for the opportunity. And what you'll see is they've got a lot of sites that they're going to start actually drilling and pulling up ground. And if they find a whole bunch of stuff underneath there, you can only imagine what's going to happen with their stock. But what I want you to see is we've gone from near oversold conditions, and now the RSI is starting to rally. And as many of you know, momentum leads price. Now let's take a look at their projects real quick here. The first one they've got is a Cornet. It's a lithium project, and they've done some airborne magnetic surveys. They've got the ground-based deep penetrating electromagnetic survey done, and they've got the bedrock sampling done. And that means they're looking to drill this year, and they've got their permits done, and they think they're going to find a whole bunch of lithium and other metals there. They've also got Peglegith project, and they've think this one's got a whole bunch of lithium in it, and this is a great location, and they've got over 1,409 hectares spread over 20 kilometers. They claim that the rocks, the intrusive rocks that have peglement segments, well, that's what you look for when you're trying to find lithium. And they've also got PG Highway Project. We're looking for copper, zinc, lead, gold, and silver. They've done the magnetic surveys, the ground penetrating radar, and they've got the permit. They're looking to potentially start drilling later this year. So what I want you to see is they've got a bunch of paid off ground. They're doing their legs work here. They've done the exploration. They're about ready to put some holes in the ground. And if it comes up with great results, you can only imagine what that means for their stock. And as we look deeper into their stock, we're going to zoom in. Again, traded on the OTC under BTKRF and on the CSE as a QMET. What we can see now on the 6-month chart is a bottom here at 1 cent is taking place and moving higher up to 3. The next target being 6 cents all the way up to 9 cents. So you're looking at potential double or maybe even triple of their price as momentum on their RSI is moving higher. You've got a positive cross on the MACD from oversold conditions. All the technical indicators pointing to higher prices. They've also got their Lorraine project of PGE is looking for copper, nickel, cobalt, and chromium, as well as the Mackenzie East property where they're looking for gold and copper as well. But what they're most excited about is their announcement today is Q Battery Metals acquires Pontac's lithium projects in the James Bay region of Quebec. And here they've entered a share purchase agreement to acquire 100% of the issued and outstanding common shares for the Pontac's River area of the James Bay region of Quebec. And what this does, it covers 5,376 hectares and 101 contiguous claims located within what's called the Lithium Triangle. This property is surrounded by other significant lithium plays, including Patriot Battery Metals, Pontac's Project, Brunswick Exploration, Srita Lithium Properties, and Lit FT Power Limited large land package, including the Moyani Project. The newly acquired Q Battery Metals property is strategically positioned in an exceptionally active and promising area for lithium exploration. So they're really excited about this and what they're going to find there. And again, you start looking at their stock now as we zoom in over the last 30 days. And what do you see here? Volume support at 1 cent a share, trading now at 3 at time recording, suggesting a lot of upside potential here for Q Battery Metals. And again, they're traded on the OTC under BTKRF, on the CSE under QMET. They've got over 51 million, almost 52 million shares outstanding, and they're capitalized. They've got the money to drill, so they're looking to see their stock price move up. Again, we're looking for a potential double, maybe triple. They find something under the ground they get excited about, well, it can go up a whole lot more from there. But as always, with any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.